I get to do the net farm income forecast. Certainly last year was a challenging year. So to start this off, I kind of have a couple of introductory survey questions, and then I'll also have one at the very end. So don't jump off at the very end until I get to ask that last question because it'll be the most important one here. But to work the survey, basically take your cell phone out. You can scan this QR code right here, and it should take you to this page. And I'll have a couple of questions going forward here. I think the QR code is actually on my next slide too. So basically, and again, answer this question based on if you've read my publication, before you read my publication, what percent of our farms had negative net farm income last year? So you should be able to answer that right on your cell phone. And while you guys are thinking about that, um, let me just mention my profile picture. I have some corn in the background. So even though that's a stock photo, it very well describes our corn situation here in kind of northeast, north central Kansas, because the corn outside my back door here is about as good as I've ever seen. It looks like something I was seeing in central Illinois where I went to grad school at. So anyway, so at least this part of the state, we're looking pretty good so far. And again, Kansas, a lot can change between now and harvest time, but at least the summer crops are looking fairly good at this point in time. All right, so this question asks, what percent of our farms had negative net farm income for the last year? And as you guys know, it certainly wasn't a great year for net farm income. And right now we have answers here from pretty high to fairly low. So let me go ahead and click on and see. I think this will show me the answer when I go forward, I believe. Oh, here we go. Here's mine. The correct answer was about 30% or so. So like most people kind of overestimated. I mean, I can understand that based on how much lower net farm income was this last year compared to other years here. So let me ask the second question then. What will net farm income be in 2024? Answer to the nearest thousands of dollars. So if you think it's going to be $50,000, put in a 50 for that. Oh, and by the way, you can't answer negative on this one because it won't let me go below zero. So if you think it's going to be below zero, just put in zero. All right, so let's see what the correct, well, I shouldn't say correct answer, but right around $100,000 or so. Well, actually, I think it's maybe just a touch lower based on what my updated forecast was, but somewhere around there, which will be an improvement over this year, but certainly not great. So again, I appreciate your help with that. So I'll come back and I'll have one more question at the end that I'm really more interested in than these earlier questions. So let me jump out of this one and share my main presentation. All right, so net farm income for this year and next year, again, there's a lot of unknowns with this. So at this point in time, I kind of have an idea of what the wheat yield is going to be. And certainly it's probably going to be down a little bit, at least in some parts of the state. For the rest of the crops, for corn, soybeans, given the limited amount of information we have, I'm pretty much assuming normal yields for this point in time. And then when I forecast things like prices and that kind of thing, I'm basically just using the futures market as a guide there. So certainly a lot of unknowns. It gets even more dicey when I move up to 2025 because at that point I have very, very little information at all. At least for this year's forecast, I have a pretty good idea what net farm income numbers are going to be because the payment always is a year delayed before it actually comes out. So I really know those numbers for this year, but I don't know so much next year for the government payment number. And the same with yields and prices. Again, the future markets becomes more spotty and less certain. And certainly I have to just make an assumption for average yields for next year as well here. So that's going to be my most unreliable one. There's certainly less validity, probably even than our 2024 number, but there's some here. And then when I get closer, I'm going to do this kind of a similar presentation at risk and profit this year. And at that point in time, I will have better ideas for the summer crop yield. So I have a better idea of what net farm income is actually shaping out to be. So I'll probably take another month or two for that to kind of shake out to get some early estimates of yields. So what I'd like to do today is review the last 10 years. Mark did that in his webinar a few weeks back. I'm going to focus mainly looking at more of the distribution than looking at just maybe the average or median numbers that Mark had in his. I'll give you my forecast for this year and next year, and then I'm going to show you where inputs are headed because two of the biggest inputs I do forecasting for. So I have a forecast for basically diesel fuel prices and also one for fertilizer prices. First, let's start with the overview of the KFMA farm financials, looking at the debt levels, interest rates, net farm income, and balance sheet situation. And here is basically a CDF. So CDF is basically a cumulative distribution function where it takes all the farms and it ranks them from the lowest net farm income to the highest net farm income. And when you do that, you get a graph like this. So this is really the entire distribution. You can think of this blue line. You can see it's a series of points. Each one of those points really represents a farm from our database. And you can see what the last 10 years look like. I like to look at this kind of graph because it gives me a pretty clear idea of what percent of farms basically have zero net farm income. You can also look at this graph to find out what the median net farm income is. So you look at the 50 percentile level, which is right in the middle, which 50% of the farms are above, 50% of the farms are higher. And you can trace this over and then you can see what the median net farm income is for that particular year. So let's say like for last year, where our median value is here, if you trace this over, you'll see that the median net farm income was probably about, I don't know, maybe $80,000 or so, right about here. But again, I kind of like to focus on, well, what percent of our farms had negative net farm income? You can see last year it was right at 30%. That's really a pretty high number compared to the past 10 years. There's only been one year, and that was in 2015, where we had more farms that actually had a negative net farm income, where we had almost close to 40% of our farms not earning any kind of positive profit here. So contrast that with what we had a couple of years previous. In 2021, we only had 5%, which is a very good year. And in 2022, we only had about 7%. But you'll notice even in the very best years, we're always going to have a few farms that are probably not going to have that will have negative net farm income. Some of that may be because I think there's probably a few farms where profit motivation is certainly important, but probably not, it may not be the most important factor that they're looking at. If you have some other off-farm job or something like that, and as one of my former colleagues used to say, for some of these part-time farmers, and I would consider myself in that category with 7 acres, that a lot of the reasons why we have agricultural equipment is because we're kind of recreational tractor drivers. So I don't want to put any of our KFMA farmers in that category, but there are some folks that in that group that really just like to have new machinery, and nothing wrong with that. I mean, it's all based on utility function. So if you're happy with that kind of thing at maybe a little bit lower profit than you could, that's go ahead and do it. I mean, it's all what makes you happy, really.
Hey, Greg,
Okay.
got a quick question in the
Yes.
chat. Is this a Schedule F net farm income or is it accrual adjusted?
It would be basically the accrual adjusted, yes. So I'm using the KFMA farm numbers to do this, and they're doing the accrual adjusted numbers. So yes, this would be the accrual adjusted numbers. Well, I guess the positive thing to look on this is, okay, so we had 30% of our farms that did lose money last year, but on the positive side, 70% of our farms did make money. So that if you want to be optimist versus pessimist, I guess that's the better way to look at that thing. And the other thing I want to point out too here, so the more horizontal the line, the bigger, the wider the distribution. So you can see like a year like, well, let's say like 2021, we had a really wide distribution of net farm incomes. Contrast that with maybe like 2016, where they were more bunched in the middle, because this is a more vertical segment right here. So you can get a lot of information once you get the hang of looking at a CDF. I remember in grad school, it took about a year before I finally felt comfortable looking at these things. A lot of people, though, are more comfortable well, I'll get that here in a second here, looking at the probability density function. Well, what happens when we take the set of farms and we average these across 10 years, because there is some jumping around of farms from year to year. Not always, though, but there is a little bit of that. When we take the set of farms and we average the 10 years together, now this I'm looking at a panel set. So there's the same set of farms in the same 10-year history. So that's going to take my set of farms down a little bit. But I do get more consistent numbers that way by making sure the same farm is in my analysis and every single year. So when I take the 10 years, average them together, here's what the average net farm income look like, you can see that the median number here is about right here, which is about, I'd say about $75,000. So, that's not too bad, really. I mean, you can certainly probably survive on $75,000 average net farm income over the last 10 years. Again, there's still, even in this kind of situations, there's still a few farms that even averaged over 10 years. Their average net farm income was below zero. But again, there may be other factors besides profit motivation as being the main driving factor for some of those farms is my kind of hypothesis for that. Well, here's a probability distribution function. So this graph here is similar to this graph. It really says the same thing, except it's a different format of showing it. It has a histogram. The PDF is basically just putting a graph around the histogram like you see here. So this would be the number, you could say this is the number of farms in this particular category here. So again, our average or median is right here about $75,000. And again, we have a few farms on either tail of this. Just looking at the PDF, I would say our distribution of net returns is somewhat skewed. We have probably, it drops off pretty quickly once we get past here. Whereas on the right-hand side, it tends to go out farther, which means we probably have a wider distribution of farms earning a wide range of profits here over on this positive side of the net farm income. And then here's just a count of the farms. Basically, how many years do you have negative net farm income over the last 10 years? And this is this makes me feel a little better here because if you look at this, over the last 10 years, our second biggest group of farms, every one of these farms right here had a positive net farm income for every one of the last 10 years. And there were certainly a couple of challenging years during that time frame. And again, the biggest category here is only 2 years. So that's pretty good to have this number of farms that really didn't have that many years as negative net farm income. And it really drops off here on the right. We have a couple of farms that had, again, several years of, quite a few years of negative net farm income. There could be a couple of reasons for this. One might be the fact that there are some farms that have motivation besides strictly profit. And the other thing could be, and I would say beef farms might fit in this category more than grain farms, but I call this the General Motors or the Ford Motor Company way of earning a profit. You might have years and years of negative net farm income if you're Ford. Suddenly you have one gangbuster year where you make a whole bunch of money, and then it kind of makes up for some of the bad years. So that could be another reason explaining why where you might have the majority of the years where you had negative net farm income, but you might have one really good year that would offset the other ones here. So two explanations for why our histogram of the number of years of negative net farm income might look like it does here. Well, what does our balance sheet situation look like in Kansas? It's actually pretty strong. You'll notice here the darker blue line, this would represent the amount of debt on the farm, and you can see while it's been going up, it certainly has been overshadowed by your increase in equity value. So you guys can all imagine why the equity side has been going up higher than the debt side, and that's because of appreciation in farmland values. Now, what that really means is it makes our debt to asset ratios look really, really good, even though our debt levels are going up. Again, they're kind of hidden from this because this increase in land values is far outweighing any increase in debt that we've taken on here. And that's one of the reasons why I always say that debt to asset ratios really are not a good measure of predicting if a farm's going to be in trouble or not, because by the time you start to see debt to asset ratios look bad or look like there's going to be troublesome, we've probably already been in a farm crisis for a while. That's one of the reasons why in the 1980s farm crisis, why I think it kind of snuck up on people, because for the longest time, the debt to asset ratios looked just fine. Suddenly land values crashed. By the time they showed up on the debt to asset ratio that following year, we were already in a pretty bad crisis at that point here. So don't look at this as a leading ratio. I tend to look at this as a lagging indication of what's been happening out there. And let's look specifically now at the debt to asset ratio and the amount of debt per farm acre. So again, debt to asset ratios look really, really good. But remember, this is being driven by the fact that we've had a lot of appreciation in land values, even though we have been rising debt. So our current levels here of 20% debt to asset, that is really, really good. That in our entire history of KFMA farm data, this is the lowest point we've ever had been on the history here. So typically, we think of debt to asset ratio. If we're in the low 30% range, about a third of our farm making up debt as our asset base, that's usually considered to be fairly normal here. You notice here during the 80s farm crisis, we were in the mid 40 range here for the eastern part of Kansas. I would say lenders are going to get a little, they're going to start to ask a lot more questions when your debt to asset ratio gets above 35% or so, certainly above 40. They're going to ask a lot of questions. I don't think you'd find too many lenders would make loans with debt to asset ratios above 50%, unless you're probably one of the chicken integrators. Some of those lenders will make loans higher than that, but your typical grain farm is going to have trouble getting loans once you get beyond or up to this point right here. So again, this is the good values. It really is from land appreciation. Here's what's been happening on the debt side, though. So if we take all our debt and we allocate it across all the crop farm acres that we farm, you can see there's been a pretty steady rise ever since the kind of the we recovered from the first farm crisis. So here we are at the height of the farm crisis. We got to this point right here, kind of recover. We started back in the 90s, and we've been adding debt every single year for most farms across most regions during that whole time frame. We kind of backed off a little bit in the west here. I don't know if that's going to carry over to the other two regions, but out in eastern Kansas right now, we're looking at the average farm debt per crop acre. That includes rented and owned land at $400 per acre. And looking at this as an interest per crop acre. So even though we've been raising debt, thanks to low interest rates, really our interest per crop acre has really remained kind of steady here, right about $15 here in East Kansas and maybe about $12 in central and east. So it hasn't got out of hand yet, but again, low interest rates have kind of helped this situation out. Here's what's the good situation is, though, and again, this is being contributed to by the fact that we have fairly low interest rates, is that the interest expense ratio is really, really low. You can see we have the top 25% of farms with the lowest number here. They practically have zero debt, whereas even the farms with the most debt, their ratio is probably about I would say probably about maybe 6 or 7%, which is really pretty good. Normally the red flag area for this is 10%. So when we start to get above 10%, you're basically saying you're taking $1 or taking a dime out of every dollar you bring in as far as gross revenue goes to paying interest. That becomes a problem at that point in time. And you notice what happened during the first farm crisis of the 80s is, we were having some farms pay 25% of every gross dollar brought into the farm for interest. And that's really too much. You're not going to survive too long at that level of interest expense ratio. Whereas if you're below 10, you're probably in pretty good shape. Comparisons of interest rates. Here's what gives me a little bit of pause for what may happen in the future. You'll notice here, our KFMA farms really they kind of follow the prime rate. The prime rate tends to jump up and down more than is more volatile than what the rates that farmers are paying. That's because farmers are able to lock into long-term interest rates for land purchases. But for the most part, there's a pretty high correlation for here. Notice what's been happening over the last year or so, thanks to higher inflation, is this prime rate now has jumped up quite a bit. I don't know if it's going to come back down if we get inflation under control, but at some point in time, the interest rate that Kansas farmers are going to pay is going to go up too. And once we start to get up to a higher rate, then these other ratios, like looking at the interest expense and the amount of debt you have, are going to become very, very important. I don't think we're close to a 1980s farm situation yet, but that always is in the back of my mind. What would it take for another 80s farm crisis to actually happen? Certainly high inflation, high interest rates would be one of the contributing factors that might go into that. All right, let's talk about my estimates for net farm income. Again, this is kind of based on mid-June when I first started working on this. It's based on a subset of KFMA grain farms. So my numbers don't quite match exactly with the numbers if you go to Ag Manager and look at the KFMA numbers, because I'm limiting my grain farms to farms that have 3 years of data over the last 3 years here. So I kind of need that recent history to do some forecasting ahead. So that brings my number of farms down in my analysis. I think I have about 493 farms currently that I'm looking at to do my modeling with. Again, I assume normal yields, which in Kansas is always a big if. I do have the estimate for what the current wheat number looks like based on some of the USDA projections. And again, I'm using futures market as a idea for what grain prices may be going forward. I'm not sure how well this is going to show up here on a presentation, but to go along with my presentation, there is a written presentation up on Ag Manager where I have written up my forecast for this year and next year, and I have this particular one in there, and you can take a look at it there. But you can see basically what happened in 2023. And we had a problem with our grain revenue. Now, some of it was due to prices, but also a big chunk of this lowering of the revenue for last year was with the fact that we had a big change in inventory value. So when 2022 ended, basically we record the remaining grain inventory at one price. Well, as that grain is sold during the year, we basically saw a decrease in inventory values because of that. And that helped make these numbers lower than what they probably would have been otherwise, which contributed to the fact that our basically our value of farm production, or a measure of gross revenue in the farm, went down by over $100,000, basically from $970,000 down to $880,000. So that was a pretty good sized jump down. One thing that did help us out though, last year and actually the year before, was we had really high payments to crop insurance. We had $124,000 last year, and we had $153,000 the year before. You know, those payments do not come without some kind of a future payment or cost down the road because of the fact that we've been using crop insurance pretty heavily. That means you're probably likely seeing higher crop insurance this year and next year, probably at a higher increase than all the other expenses are going up. So I kind of factored that in on my expense side. Now going forward for this year, you know, I think maybe prices maybe have kind of bottomed out, hopefully. But because of when I'm not looking at a big change in inventory values, my revenue numbers for the crops actually look a better this year than they did last year. But a lot of that is because I don't have to worry so much about that change in inventory value like I did last year. So because of that, I'm looking at some bounce back in our gross revenue number, value farm production, up to 910. It's still going to be probably below what it was in 2022, and maybe a little bit higher bounce back based on the futures market going forward in the next year here. So on the expense side, most of the expenses, I'm basically using the USDA indexes to estimate what the rate of increase is. A couple of things I want to talk about is the fertilizer and the crop insurance. So I certainly built in about a 15% increase in the crop insurance premium. I don't know if that's enough or not. I'm having to take a little bit of a guess for that, more than I would really like to for this number. So I'm building a higher number in for that. The fertilizer side is a little bit interesting though. So I'm actually forecasting a little bit lower cost for fertilizer, but that's really because I think 2023, the fertilizer costs there actually reflected the fact that some farmers purchased their 2023 fertilizer at the end of 2022 when fertilizer prices were still pretty high. You remember in 2022, fertilizer got up and hydrous got up to over $1,000 per ton, and it kind of started going down after the first year and about halfway through the year here. So even though probably fertilizer prices ended up in the $700 range, I think some farmers last year probably paid a lot higher than that for 2023. So it was better than what it was in 2022, but it was still higher than I think what the average fertilizer price was for the year here. So that's why this is going down when you really may not necessarily see that. Is because farmers paid earlier for fertilizer, and it's not fully being reflected now into this point right here. So even though this number's down, it still represents a pretty high number for fertilizer prices. So fertilizer price right now for anhydrous is I think in the mid $700 range. To me, I think that's kind of the bottom number. And I'll talk a little bit more about that when I get to the specific uh, 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 expense costs for those kind of things here. So again, a little bit of decrease, but it still represents a pretty high level of cost here. So when we take everything together and look at that, you can see basically I am seeing a little bit of increase from about $90,000 up to 118. That's a pretty good percent wise. I think about maybe 30-some%. But again, that's a fairly low base to start with. So even though it looks like a big increase from just a raw dollar amount, that's still a pretty low net farm income compared to what it has been over the last dozen years or so. And kind of a similar situation going into 2025. I don't really expect to see much improvement unless something else drastically changes. And over here, you can see I have this in my written report too, but by the areas of the state, a lot of these differences you see among the state kind of reflect the fact that we have bigger farms out in western Kansas. It reflects the fact that they will probably have higher net farm income just by the fact that they have more acreage that they're working with out there.
Hey, Greg, I
Yes.
have a question in the chat. Due to reduced futures prices and resulting coverage, won't crop insurance expense be down in 2024? Most quotes I'm seeing are actually lower than
Oh,
2023.
okay. Well, that'd be good if they were. I just kind of expected based on assuming farmers got the same level of coverage and the fact that we've been having to use it more. I kind of modeled that going up here, but if they are, that would be a great thing, really.
And then there was an earlier comment that I didn't get to you. It was about the interest per acre. I presume interest per acre is real interest.
Uh, that's the amount of interest that, yeah, that's well, when you say real, I'm not sure what you mean by that, but that's the dollar amount of interest that they're paying. And I guess it'd be an accrual adjusted amount too, actually. So
All right, that's
it,
all
it
there
wouldn't
is.
it wouldn't include like a management charge or anything like that, if that's what you're asking.
Okay.
Okay. All right. So our summary of for the next year, to me, it looks pretty challenging based on what the futures markets show. Again, I expect to see a little bit of bounce back, but it's certainly going to be, I think, a challenging couple of years unless future prices suddenly go back up. And as always in Kansas, rainfall is going to make a big difference, I think, into what the final net revenue number is going to be. But again, I would prepare for kind of a tough couple of years going forward here. So what's been happening at the margins? Again, I always kind of look at like that to see how farmers are doing. You'll notice here that I basically have the median and the average. Well, the average up here and the median here. So there tends to be a difference in these because the median is the midpoint, and we have enough bigger farms to kind of raise up the average over what the median would be. So this is a typical graph we see with our KFMA farms, is that our average is almost always higher than what the median values would be. This 25% percentile basically says 25% of our farms are going to have this level of net farm income or lower, and this top one here says 25% of our farms are going to have net farm incomes at this level or more than this. So that's the way to look at this graph. You can see it's pretty flat for the next couple of years. Again, here is the distribution of what it would look like, the CDF, like I showed in my earlier graphs. You'll notice here's our current year, 2023, and this is real data here. So these are real numbers, about 30% of our farms with negative net farm income. You can see next year, even though I'm predicting a little bit higher average here, we actually have a higher percent of our farms in this negative category. It's pretty close to 35%. That to me is worrisome when we have over a third of our farms that could have a negative net farm income over the next year or two here. So you certainly can't go too many years like that and have negative net farm income and expect to remain, in business too long like that. So to me, this is the biggest worrisome issue right here, not the fact that our net farm income is lower. It's the fact that we do have a fair percent of our farms with negative net farm income numbers. All right, let's talk a little bit then about input prices for next year. So I do modeling for both oil and diesel and fertilizer. And in fact, the oil and diesel predictions kind of guide my fertilizer prediction for the coming year. And the key for basically all these things when I'm predicting um, diesel prices, the key for doing this is to predict what the oil price is going to be because there's a very, very high correlation between what the oil price is and then what the fuel price would be. And it works really, really well for the gasoline market. I can almost tell this is probably about a 90% or higher correlation between the oil price and then what the predicted gasoline price was going to be. Now, diesel is not quite as good. Now, it used to be really, really good. My correlation when I looked at the oil price and the diesel price was almost just as high as what the gasoline side. That has changed over the last 3 or 4 years, where it's not quite as accurate as what it used to be. And you notice here, the oil price doesn't quite predict the price of diesel fuel as well as what it did at one time, especially on these high end of the oil prices here. When it gets lower, it tends to fit the model a little better, but it almost looks like maybe I shouldn't be using a linear regression model for the diesel side. Maybe it should be more of some kind of curve linear relationship here. So that's something to bear in mind, but it's still a pretty good model, even with the fact that we do have a few points out here that aren't quite fitting on there. I think there's probably more variability in diesel prices than there is in gas prices. Well, what's been happening with the oil prices for the last year? Basically, since this is from May of 2023, you can see been quite a range, basically from about 68 up to about $90, $92. We're currently kind of in this upper $70 range or so. And to me, this is a little bit surprising because if you remember, think back at the start of Russia-Ukraine war, oil prices got up to $130 per barrel, and there was a good reason for that because Russia is really they're right behind or right ahead of Saudi Arabia as far as world exporters is concerned here. So the thinking was, okay, a war is going to affect oil production over there, and it's going to affect world oil supply, and we're going to see a big jump in oil prices. That didn't turn out not to happen here. So oil prices remain pretty steady here, and we're not. Russia so far hasn't really been affected as far as their oil supply is concerned here. And to me, that's a little bit of a worry here because I don't know if traders are really fully factoring that in. If you've been reading the news, you know, Ukraine now has kind of taken to the idea that we're going to go through and kind of send these drones and bomb Russian oil refineries that are close to them. So far, it hasn't seemed like it has hurt production yet, but that's something to keep an eye on here. That kind of concerns me is that at what point is that going to be a concern? Now, what we have seen now, and I'm not surprised by the least about this, is that putting tariffs on Russian oil basically does nothing because Russia can sell their oil to a whole bunch of countries. India, for one, is a glad buyer of oil. And in fact, some I've heard they've been even turning around and reselling it here. So there are plenty of countries willing to buy Russian oil, even though we're trying to put an embargo on that. Um, Again, for me, the oil features don't really provide a whole lot of information. So there it is a several years worth of oil features. It goes out pretty far. I think maybe 3 or 4 more years, but they're all right in the 70 high $70 range. There's not really any information to gain from looking at that from my book. So I'm not really sure what traders are thinking about by providing such a low margin about that. Well, they haven't necessarily priced that a little bit higher here. But again, I'm using that as kind of my best guess for oil prices going forward. And part of the reason why I think we've been seeing some issues with the diesel side of things is that refinery capacity in the U.S. is still a major concern. And I don't know, with the fact that the EPA is so many restrictions on actually building something like that, I don't know if we're ever going to increase our capacity. I think the only thing that might help with this capacity side is the fact that we might make a big jump possibly to more EV vehicles that would take pressure off the gasoline side of things. But as it currently stands, you can see we've had this amount, we're currently this level of capacity. That's down. Here's pre-COVID right here. We're down a lot from what the pre-COVID amount was. You can see we shut off a lot of capacity during COVID when we weren't really using much oil, and it's come back online. But this is kind of, I think, at our current peak right now. Certainly, we can probably get this a little bit higher, but we're never going to get our capacity was what it was back here. I think this is the point where we will never ever see again. And the capacity we do have, we use it very, very efficiently. We almost have a 90% efficiency rate for these refineries. And most of these refineries were built probably at least 50 or 60 or more years ago here. So to me, the oil industry has done a wonderful job of making use of some older equipment, some older things here to get the oil that we are having out there here. So to me, this is the issue why I think you're going to see some volatility, especially on the diesel side, because this limited capacity, like you see here, has caused our diesel stocks to get really, really low here. So here's this gray area. This is our normal range of diesel stocks over the last 5 years. This blue line is where our stocks were last year, and this green line is where the stocks are currently in 2024. And you can see we're at the bottom end of this 5-year range for last year and this year both here. And that's one of the reasons why you see diesel prices tend to jump up quite a bit, is that when our stocks get kind of really low, and that puts pressure on prices at times, and certainly makes the price more volatile. Now, on the gasoline side, it's not quite as bad necessarily. I think they tend to put more emphasis on getting gasoline out there because there's the consumer base to complain is a lot bigger than what the industry and trucker and farmer base is to complain about diesel prices. So from my political perspective is I think the refineries and oil companies feel some pressure to produce gas at the expense of diesel fuel. Again, that's just my hypothesis about that. But we're still fairly low for gasoline at times. We're probably a little better here. Maybe why you haven't seen gas jump up and down quite as much, but certainly on the diesel side, there has been a lot of price variability right there. And it kind of shows up here looking at this price premium for diesel fuel here. This to me has been kind of interesting for the last year. Here's the gasoline price, here's the diesel price, and I plot these two basically to show you what the price premium is for diesel fuel is for the last month. So you can see it has varied a lot over the last year. It has gone down as low as 10 cents. It has been as high as 90 cents. And we're currently right here at maybe about a 15% price premium. So if this year follows what happens last year, I would expect to see that price premium start to go back up, which says to me that we may have reached our low price of diesel fuel for the year at the current low price premium. And if this premium widens back to more of the $50, $60, $70 range, you're going to see diesel prices jump back up because of that here. And I haven't come up with a good reason why to explain why this premium has varied so much over the last year and this year, both here. At one point in time, when you go back in the real far past, the premium was probably a consistent, maybe 10 or 15 cents. At one time, I had a diesel, I bought one of the diesel Jettas. Gosh, that's been a long time ago now. And I bought it really because diesel fuel was consistently below the gas price, but it hasn't been that way for a long, long time now. I think over the last 5 years, probably more of a $50 to $60 premium has been more typical. Um, Because again, looking at the price premium, how that has changed. So here's what happened last year. Basically, we had a real high premium going in, got pretty low to almost zero and went back up. 2024 is following the 2023 model almost exactly so far here, except take out these first initial weeks here, but it's gone down. Looks to me like it may be starting to go back up again. If this continues to follow this trend here, I would look at a diesel premium, the gas premium up in the 80 cent range come maybe October or so, right at the time you would need fuel for fall harvest. So again, my recommendation for diesel fuel is don't wait till fall harvest to buy your diesel fuel. I would probably look at buying some in the summer if you have storage to take it on. And then here's my forecast for diesel prices. This is an assumption based on what I have seen for the oil futures market. And you can see basically, since I can't get a whole lot of information from the futures market, I'm basically predicting the highway price to probably be maybe about 360, 370 for the next 12 months or so. So that's kind of what it looks like. We'll see how accurate I turn out to be. And now let's move over to the fertilizer side. So again, I kind of I'll have a model update maybe 2 or 3 times during the year about what prices should be. It's based on the corn futures price. It's based on the oil price, but I lag that by 6 months. This is to get my idea of what the supply might be. And then the corn futures is represents something about demand because the higher corn price is, probably more corn acres and the more you're going to need anhydrous and other nitrogen fertilizers. And I also have inflation expectations in there as well here. So here's what my current model looks like. I'll try to write this up in the next few weeks, but the model really hasn't changed a whole lot over what my most recent one has been here. These numbers vary a little bit, but this is still pretty close to the model I have out there in Ag Manager right there. For a while there, my model didn't work when oil prices and fertilizer prices jumped up to $1,000 for anhydrous. I have since added inflation. That helped quite a bit. In fact, inflation now with anhydrous is actually my strongest component of my model. There's a 0.83% correlation between anhydrous and inflation right here. All three of these things will have pretty good predictive power. So I've been using these three factors, and my model's been working pretty well. The only issue right at the moment is we don't really have that many data points for fertilizer for anhydrous has been above $1,000, so I have kind of limited data there. But based on what I have seen so far, I'm fairly happy with my fertilizer model. And you can see how my model has actually predicted things based on the historical numbers here. So this model goes back to about 2010 or so. The red line, dotted line would be the actual anhydrous price. And the green one is my predicted value price. And you can see where we are right about here. It doesn't quite hit all the highs and lows, but it really comes in pretty close. Let me show you this on a kind of a little tighter time frame. Here is things over the last couple of years, and you can see how my model's been working. So here we are right here in 2024. Here's the actual anhydrous price, and you can see here's what I am showing for my predicted price. I'm a little bit higher because I think my inflation number that I'm using in my model is a little bit higher than what the current inflation rate might be kind of actually is out there. So inflation, as I mentioned, is really a pretty important part of my model right now. So I'm having a little bit higher price. The jump you see right here is because in my 12-month forecast ahead for the anhydrous price, I'm actually bumping up inflation, I think maybe from like 4 to 5% or something like that. That's the reason why you're seeing my fertilizer price jump back up. Now, if my model is accurate, and if my estimation of inflation is accurate, I think we may have bottomed out for anhydrous prices for a while. I think the current rate may be about as low as we're going to go. And I wouldn't be the bit surprised to see if oil prices suddenly jumped up thanks to something in the Russian-Ukraine war, or if we saw inflation jump up. I think you could easily see anhydrous go above $1,000 possibly. Again, I don't want to say that we're going to go there for sure. I'm happy that we're here right at the moment, which is better than what it was up here. But it's certainly a risk factor to consider when you're out looking at inputs for next crop year. The nice thing about predicting anhydrous is because once I know which way the anhydrous price is going to go, all the other fertilizer prices tend to kind of follow suit. There's a very high correlation between all the fertilizer prices and anhydrous. Even for potash, where there's no nitrogen at all involved with that, there's a 0.78 correlation between those here. So if you know anhydrous is going to go up, you can kind of assume that all the other fertilizer prices are more than likely going to go up as well here. So again, the Russian-Ukraine war is always a factor in this because not only are they Russia is one of the biggest oil exporters in the world, they're also one of the biggest fertilizer exporters in the world too here. They are major exporters of all three of the major fertilizer categories, the N, P, and K here. Something to watch out for, that a spike in oil would probably also lead to a spike in fertilizer prices. So let me go back to my last question here. Let me stop this share, and then we can come back and take questions as you guys answer this particular question here. Uh, let's see. Okay, let me go to my next slide. Here's the one I'm more interested in. So take your phones out again and scan this QR code. And oops, let me go back here. First of all, make sure you scan in here, then I'll go to the next slide. So the next slide is going to ask you what are some of the factors that are going to be important in the next year. I'm more interested in that than really what you had in my other two questions. So go ahead and scan this one in, and I will move forward to the next slide. So you basically now can enter input up to 3 different factors you think will be driving net farm income in 2024. So maybe something I talked about or something I didn't talk about or I think about, but go ahead and key those in on your cell phone. And I guess I can go ahead and answer questions at this point in time. I'll just see if I can remember from memory, Rich, what one of those questions were. One was about rental rates and land values, which way I think those are going. My first thought right at the moment would be that I think the land values and the rental rates are probably lagging behind what's been happening a little bit with net farm income. So, theory would basically say that, our land values and rental rates should be driving what's been happening with net farm income. So the fact that we had lower net farm income last year and the fact that we're looking at a forecast for net farm income being low too, that would tend to drive down cash rental rates and land values. But again, there is some lag there. So I'm not fully sure that we've caught up to what the average, maybe the net farm income has been over the last 5 or 6 or 7 years or so. And that I don't really see much of the land values or rental rates going down going into the next year because of that here. So I would look at maybe steady prices for land prices and cash rental rates. Was there other questions, Rich, that I can answer?
We have one here. Are you combining corporate and personal incomes on each farm?
Corporate, now, what now? Run that question by me again.
Are you combining corporate and personal incomes on each farm?
Uh, it would be the net farm income. So that the personal income is not a factor in the net farm income number. So those should be separate. Now, some of the farms do keep track of family living. So we do have those farms who do that. We do have some outside income numbers, I believe, in there. But yeah, for the most part, well, really for all the part, the net farm income is the farm net farm income. It's from the farm.
And folks, I have opened it up. So if you want to unmute and talk to Gregg, you can do that, or you can type something in the chat.
So you guys, this is what a cloud graph looks like. So the bigger the word on the screen, the more people have said that particular thing here. So I'm not surprised to see weather is one of the biggest things up here. I'm a little surprised that so many people are saying interest rates, but because I'm not sure everyone we have a lot of farmers out there now who, weren't in the farming in the 80s who really didn't experience interest rates in the double digit range here. But, I can remember that because I think it was in high school when that happened. So that's still is important to me. But certainly, my students I have come through my farm management class, they have no idea, double digit interest rates and the havoc that can kind of cause.
There was a question that had come in coming into this meeting about grain prices, and I think that how was it stated, Rich? I think uh, basically who influences or what factors are influencing grain markets, and I detected out of that really probably a frustration in some of the most recent trends in grain futures. Rich, was that the gist of that question?
And they also were wondering about the role of managed money in that with the hedge funds.
Yeah. Okay. Well, I have some information on that, and we'll try not to belabor it, but I just wanted to show some info that we've got. You can see here on this first chart on U.S. Well, basically, it's the seasonal price patterns that the futures, similar to what you had talked about, Greg. When you look out to the 2024-25 marketing year, that basically they were putting most of our emphasis on the upfront contract, kind of a myopic forecast, and then doing just marginal seasonal changes, if any, going forward. So you can see that the projected price for the next marketing year by the USDA was $4.40, and we've been in the process over the last month of seeing that. I guess our calculation here at KSU of what season average prices would be, again looking at futures in the next marketing year using a reasonable basis assumption, basically the current basis, and taking that forward, we're now down to about 451. We were 20, 30, 40 cents higher. So what's happened here of late with the futures in the most recent trends that they've been, have certainly affected that. And as you can see, it's pretty much it's reflected mostly in the upfront contract in that next marketing year. Of course, that'll be the DEAS. That'll be the DEAS contract. We have the September futures. That marketing year starts September 1, but we really, what elevators are doing for pricing, they'll by the time they get into the month of September, they'll be figuring basis estimates off December. So go on to the next chart, if you will, Rich. So we had a question about managed money traders, and we try to follow this using weekly CFTC data. And I think the thing that stands out on the managed money traders or the specs is that they built up a sizable negative position. You can see this here with the scale on the left of that chart in terms of that's if these are thousands of if these are millions of bushels, that's 1 billion bushels worth of short versus 2 versus 3 billion bushels. So when prices had fallen down earlier in the spring, they'd gotten down to about, well, let's see, as I'm looking at this, right, 408 was the low. Now we closed in the last day or so down to 420. So again, we've come down lower. What I wonder on is we're just days from the July contract entering its delivery period, and given the selling pressure that we've seen on that, it's been going lower. Normally, you'd start to think, well, gosh, we've got some short covering that'll be happening, but yet it's a day or so away, and there's some pretty aggressive dynamics that happened in those last few days. I guess I want to see what happens in this contract by the time we actually close it out. And as you look at the volume, open interest in that, we have seen some people already flee that July contract and head off into September or December, but we're in the throes of that right now. So in essence, you can see here that as the prices have come down in the last several months, that we built up those bearish positions, and basically we're hanging on. I've got more to say on that in just a minute. Go on to the next slide, Rich. Right. So there are 3 types of traders on here. And so in that initial question, well, who controls them? I think their profit motives control them. And there's not an institution that does this. Their profit motives and their narrative on the market, what they believe and what they pay attention to. So you've got the swaps or index traders. They're almost all short sellers, and they buy corn futures in this case because they tend to correlate in a profitable way for them with their broader portfolio. So you can see they're constitutionally well, pardon me, I think I said that wrong. They're constitutionally long here in terms of their position. So not a lot of change there. That's not where the dynamics come from. You see commercial hedgers, they're in and out. We've got a chart coming on that. But they're hedgers, elevators, farmers, anybody that's using futures to manage their price risk on a physical commodity, i.e. hedgers. But the question that came in was well stated. What are the managed money specs? What are they doing? So they at this time, just implicitly, they haven't had any news in the short run that has changed their basically their idea that the USDA's projection of large crops is the rule of markets this year until proven otherwise. And you read of what's been said at major conferences, and I've been at some conferences, heard people say this. They trust in the genetics of our crops, and until they actually see a drought show up physically, they're not inclined to price it into the market very much. So if anything, we're the prices that we're seeing in the corn futures, to me, are not risk oriented. And my own personal opinion, I want to identify as my personal opinion, is that we're undervaluing the risk in these markets, particularly with some of the weather forecasts that have come out and some of the flooding that's happened that'll affect acreage and yields up to in the northern states. In years with ideal moisture and ideal conditions, it's not uncommon at all to see the high in the market in late June, early July, and that's sort of what it looks like. But it is the presumption of the market. But we've got all of July and August to come in. I'm not saying we're going to end up at higher prices, but I would be really surprised if we didn't have to deal with some volatility and uncertainty by the time we actually get out to September and have some solid USDA numbers. Next chart, Rich. Yeah, Rich, if you want to go to the next chart, that'd be great. There you go. Thank you. So in a webinar we had earlier this week, we talked at length about the likelihood of different outcomes. You can see here for this marketing year, there'd be the last two columns. In my own opinion, I have about a less than half chance, about 2 out of 5, 40% that the USDA is right in their 181 bushel an acre yield. Again, that's almost 4 bushels higher than we've ever had. That's the U.S. average yield. I'm more inclined to think, hey, let's look in terms of actually tying the record yield we've had in the past, which is last year 177.3. So and just that change with nothing else coming in, whatever may happen tomorrow with the acreage numbers, and probably there's some what can happen in that report tomorrow was based, well, what they'll show is based on June 1 conditions. We had the wet problems up in some of those states prior to what just occurred up there. So we probably, I would question whether we'll see much change in the planted acres, but we have to start wondering about the harvested acres in some of those damaged areas and what the yields will be. So just that difference in just going down to our record yield, and I'd say there's more like a 3 out of 5 chance that that's where we go and still have great yields. You're in a different market situation. You're taking about 300 or 400 million bushels off the top, and then assuming if you just take the same usage without rationing, you're down to below basically 1.2 billion bushels instead of 2.1. And that's when you look at historic price relationships. It's a difference between being at 440 and something over 5. So we're not that far out of the woods. So we can. I guess I have a cautionary note in terms of the market's current assumptions about the final outcome. Basically, we're trusting the USDA's number all the way through the trend line yield figure 181 and bushels per acre, 2.1 bushels ending stocks, 14% stocks to use, and it's only the end of June, and we have a lot of uncertainty to go yet. Next, Rich. So with that point of view, I just want to quickly show you soybeans and wheat, how they look on this. There's that same seasonality. Again, the USDA projected early on out of the Ag Outlook Conference, soybean prices for the coming marketing year of 11.20. And very similarly to corn, we've been in the process in recent weeks of knocking down that number in terms of weakness that we've seen in the soybean market, and now we're down to 11.32. So basically, we're hovering at what the USDA had projected earlier on, and again, and I would still say that if the main reproductive parts of corn happen in July, if main reproductive parts of soybeans, again flowering, pod setting, happen in August, etc. There's still a lot of uncertainty, but as we're sitting right now, the market's assuming great yields, 52 bushel an acre, record high, and see where and it's being reflected in where they're at. Next slide. And similarly to corn, here's what the managed money traders positions are. Very bearish, and I think this had a lot to do with expectations of a tremendous crop down South America, and even with flooding that they've had in Rio Grande del Sul and other maladies that hit them on the edges, they're still going to have record high production. It's just a matter of how high. So, and that number is still being debated between the USDA and CONAB, a USDA type agency down in Brazil. But point is, you can see the bearishness, the extremely short positions, declining long positions. So if we wonder what's the market thinking and where's their money at, their money is bearish. And until something would happen, if the forecasts of a resurging La Nina come back and we turn hot and dry, and by the way, that's what is forecast for July, August, September, then you'd see that change around. And I think the changing in these positions, and sometimes pretty quickly, is kind of the story of these long versus short positions for soybeans. Next slide. And net positions of traders who've explained from corn who was what in that, and you can see that the net position for managed money traders has turned bearish. That in the red over there on the right hand side of that line, the red's turned negative. So we're net short on our positions in the soybean market. Very similar to corn. Next chart. And you can see commercial traders pretty balanced, which you'd expect. Some buyers, some sellers, depending on where you're at processing or production wise. So not a lot of story there. Next chart. And so my own thoughts are that the USDA's projection, 52 bushels an acre, record high, off the acres that they have, and again an increase in acres from past year, and with that 1120 projection, that's what the market is thinking right now. And in fact, if we get if we have great production and end up, and you can see out there on the right hand side a scenario where we have lower production, higher disappearance, but still end up where we really turn a short. This would be basically the major drought scenario, and a more shortfall ultimately out of South America than we anticipated. Then you've got this guy from K-State saying, well, you end up with something like, that's almost unheard of right now, that we can't dream of, 14% stocks to use, but 4% stocks to use $14. So my contention is, as you can see how this advances through there, is that I understand where the markets are at right now. We're not worried with current weather reports. But we have these forecasts that are indicating hot and dry conditions are more than a zero chance. In fact, the last National Weather Service, ENSO projection was for a 65% chance of La Nina coming in and causing these types of conditions. So, and that's up actually. So you've got, I just think there's considerable risk out there that at this point in time, with the July contracts going off, aren't really being accounted for. Next chart.
Dan, we have hit 1 o'clock, so why don't you just briefly go through it?
Yeah, just so wheat's falling off. It's harvest time. That's the biggest issue to deal with. There's some underlying fundamentals of the wheat market that hold some promise, but until we actually see wheat go out of U.S. ports, overcoming the barrier of the higher U.S. dollar and transportation costs, then it's but I don't. The market's not inclined to respond to anything until they actually see export movement, in my view.